why don't we start, Susan, give us a précis of the report. Everyone's got it. It is worth looking at, but give us the 5-minute summary of the headlines.
All right, should we be worried about $57 trillion increase in debt? Yes and no. In the report, we point out that now, 7 years after the financial crisis, we've been waiting for deleveraging to begin. We thought in 2008, certainly people would pay off their debt, restructure their debt, and this ratio of debt to GDP would decline. And it hasn't happened. There's virtually no major economy today that has less debt relative to GDP than it had back in 2007. So the question is, what's going on here? On one hand, some of the growth in debt is in emerging economies where you expect them to be borrowing more. They have very little debt to begin with, and they're building out infrastructure, they're industrializing, and urbanizing. But at the same time, you see debt growing in places that we think is risky, and we identify 3 risks in the report. One is the tremendous growth in government debt in advanced economies. And it will not be news to anyone in this room that there's now a range of countries, Greece is only one, which have ratios of government debt to GDP more than 100%. And we do some modeling in the report and look forward based on current fundamentals. For a range of countries, government debt will continue to grow. And to start deleveraging, you would need either tremendous gains in growth or very severe fiscal tightening to start government deleveraging. And as we see in Greece, where the voters have spoke, that seems politically very difficult to achieve. So we question, do we need a wider range of options for resolving government debt? The second key area of risk would be China. China's debt has quadrupled since 2007. It's grown by $21 trillion. It's an astonishing rise. China's overall level of debt relative to GDP is now at about the level of Germany, Canada, the United States. It went from being at an emerging market level of debt now to an advanced economy. A couple concerning things there. One is just the pure growth. If it continues on this path, it will exceed Spain's level of debt in just a few years. Second is that about half of the debt we reckon is related to real estate, either directly or indirectly. And at the same time, China has a rapidly rising property market in cities across the country. A third of the debt comes from shadow banking entities, which we don't understand the credit quality or their credit underwriting skills. And then finally, there's local governments taking on a lot of debt in China with very thin finances to repay it. So some risks in China. Then the third big risk in the report that we point to is a continued rise in household debt. Not in the United States. The US stands out as one of the countries that has actually seen a little bit of deleveraging, mainly in the private sector. But in countries not affected by the crisis, in Northern Europe, countries like Denmark and Sweden, Norway, Netherlands, as well as in Asia, South Korea, Malaysia, and Thailand, Canada and Australia are also on that list. Household debt just continues to grow rapidly. It has not paused, and they now have household debt to income ratios that are much, much higher, in some cases twice the peak of the US in 2007. And as we know from the wonderful book House of Debt, this often ends in tears, shall we say. So those are the 3 areas of risk we point to. The report also looks at, okay, if we have economies that for whatever reason need growing levels of debt, what are the solutions? How can we better manage this debt? And what are the tools that we need to create a system that can have debt but avoid the boom-bust cycles of the past?
Excellent. Very, very good summary. Hopefully we will answer some of those questions. And Atif, let's start with you, since you have literally written the book on this. Which of those types of debt do we need to worry about? Do we need to worry about the overall headline number? Does that tell us very much? And where should we be concerned?
So all of it. I think the first thing to understand, if you go back to 2008, 2009, and think about what economists were saying is happening or kind of would happen from 2009 onwards, the famous paper that came out was Krugman and Edison's, which was on the question of deleveraging. I think it was in the title as well. Now that framework suggests that the global economy would slow down precisely because there would be deleveraging and interest rates would have to fall. They will try to fall below 0 to kind of balance the economy back between consumption and savings. Now that framework is very useful. What we saw a number of things that go along the direction of that framework. We saw the big decline in interest rates across the board. We did see a slowdown in growth, but we did not see deleveraging, as has been pointed out by McKinsey report. So what does that suggest? I think that suggests that things are kind of even more dangerous than Krugman and Edison have it in their model, because we went through a big cycle of levering up, and then the crisis, which had a reduction in GDP, large reduction in GDP, and the only way we could sustain the economy, even at that lower level of GDP relative to trend, was with a much higher level of debt. And I'm talking about the global economy here, of course, not just the US. It can be tricky to just look at the GDP numbers country by country, and I think you can miss the bigger picture if you do that. Let me just give you one example of US versus China, which also illustrates the real fundamental problem with the global economy. Before 2008, it was the US which was levering up like crazy, and China did not need to. It was the Chinese excess productive capacity was being utilized by the borrowers in the US. And so the key problem was this mismatch between, you can say, consumption and savings, or you can also say in terms of consumption and the productive capacity of the area that is producing those goods and services. That mismatch was being met by higher debt in the US. Once 2008 hit, the Chinese economy, which was running these enormous deficits of close to 10% of GDP, it had to be slashed by half, which is a huge shock to absorb for an economy. And the basic reaction of the Chinese policymakers was, well, let's try to boost demand domestically, since it's not as strong as it used to be in the foreign countries. And so they almost, very deliberately, actually, if you look at their policies, did that by creating more domestic debt through their banking system, through their state-owned enterprises and local governments. And that is a machine that can boost nominal GDP and also real GDP, actually, for a while. But obviously, there's a question of how long you can go about doing that. Now, if you think of that question of how long can the economy sustain a higher and higher level of debt as a proportion of GDP, one answer is that this can potentially go on forever. So, if you theoretically think about this, it is possible if some segments of the economy continue to want to save at very high rates, which is why debt gets created in the first place. As long as they continue on that propensity, you can basically, central banks can keep buying this stuff, and you can keep doing that kind of forever, potentially. The real risk is that what if that situation changes at some point? I mean, one way to think of this question is, what if at some point they want to bring that debt back at some point in the future? Whatever the corresponding debt to GDP figure is at that point, it's going to be very high. So whenever that happens, you have some of the same mechanics that we talk about in our book, which is when you try to bring resources back from the borrowers, you cannot do it at a large scale. You cannot do it suddenly. The economy is going to collapse because you're demanding from the economy a sudden reallocation of resources, which is just not possible without a big decline in GDP. So I think the big risk is we can continue to lever up and kind of sustain the level of GDP growth, as low as it may be. We can still sustain it with continuing high levels of debt. But the real risk is, what if that trend tries to reverse at some point in the future? We are going to have some of the same mechanics of slowdown or even negative GDP growth that we saw around 2008, 2009. What is the solution? I think the solution for this...
Let's get on to the solutions later.
Okay.
Let's figure out how much we need to worry about it, and then we'll get on to the solutions. Jason, the president's budget seems to suggest that debt is not something you're all that worried about. I mean, you're now happy simply with stabilizing it, possibly. It doesn't seem to be stabilized even after a while. From the US perspective, is the level of public debt worrying? Is its trajectory worrying? And if not, why not?
I think you want to take that question and situate it in the broader understanding of where we are in terms of debt in the economy, and then I'll get to the government in particular. You've seen in the United States deleveraging happen at 4 levels. You've seen it in terms of our foreign borrowing. Our current account deficit is down to about 2% of GDP, the lowest it's been since the 1990s. That was driven by a large increase in gross savings as a share of our economy. Much of that the flip side of a reduction in the budget deficit that we'll come back to. At the household level, debt-to-income ratios are back to where they were in 2002. You then take the low interest rates, and debt service to income is the lowest on record, with those data going back to 1980. And then corporations have also substantially deleveraged. So if you look at debt equity ratios, they're back where they were before the 2001 recession, around 2000. So I think we are in a much more sustainable position than we were in going into the crisis. Then you look at the government part of it, and if you look at the McKinsey report, you see a lot of that deleveraging at the corporate level, the individual level, but you do see a rise in debt as a share of GDP in the United States. Looking back, that was unambiguously the right policy. One of the reasons the United States economy is in the position it's in today compared to many of the other advanced economies is because we had a vigorous fiscal policy starting in 2008, really doubled down on it in a very big way in 2009 and subsequently. And I think that served us well, complementing monetary, financial, and other aspects of our policy. Going forward, our goal is to make sure our debt is on a declining path as a share of GDP. And to get there, you need deficits a little bit below 3% of GDP. That's happening automatically for the next couple of years because of the steps we've already taken on spending, on revenues, on healthcare. Over the medium and long run, that then starts to slip back up. So there's some things we need to do. The president proposes that, I guess you didn't want to do solutions, but you asked, I guess, how much we define the problem. Some things on revenues, some things on entitlements, and that's sufficient to get that deficit in that type of place.
What do you think, and I'm going to ask Richard the same question, what is the right, or is there a right level or a safe level of government debt in an advanced economy? And there's a big debate about the, what I'm blanking on his figures, the 90% level, the Rogoff debate, was the spreadsheet that had a kink and then didn't. But do we really know? I mean, if you look at Japan, it's not in a great shape, but it seems to be trundling along with extraordinarily high public debt ratios. So where do you, just from a sort of abstract level, what do you think? How do you think about government debt?
First of all, I think most things tend not to have thresholds, and when you see them, it's an artifact of research. And debt, it's not a dirty word. It depends on what it's for and what the context is. If we took on more debt to invest more in infrastructure, that would be a good thing for our country, a good thing for our economy. If we took on a lot of debt to build a lot of houses people didn't need, that would be a bad thing for our economy. So it really depends on what you're using it for. And then when we talk about policy solutions, whether there's distortions that are leading you to have too much, for example, in the corporate tax structure, we can come back to. In terms of the federal government, I knew an awful lot of people in 2009 that would have told you if debt levels are where they are right now, interest rates would spike. Well, we haven't seen anything like that. The market's not seeing that for the next decade. I certainly wouldn't count on interest rates staying below 2% for the next decade. Our budget assumes a pretty healthy increase over the next decade. But for 20 years now, interest rates have surprised significantly on the downside.
Richard, when you first put this report out, the first one, I remember the argument in it was, you had a big increase in public debt, and that was natural and appropriate in the light of a very big recession. But then you would have the deleveraging would come, growth would return, and you'd have tighter fiscal policy. That hasn't really played out. Why hasn't it played out? And do we need to think differently about deleveraging than you used to?
I think we might want to. I mean, we looked at the previous crises, like sort of Sweden, and what happens is you get 2 or 3 years where debt level rises, country and government debt level rises at the beginning of the crisis. Then as the economy starts to recover, debt levels get paid down. The trouble is most of the other examples we looked at when we did that analysis were single country or few country examples. They weren't global examples. Obviously, the financial crisis was a global one, and it was hard to do what Sweden did, which was to lower your currency and export your way out of it. Asia did the same. Asia financial crisis, currencies fell, Asia exported their way out of it and got their debt levels down. The trouble is if everyone is trying to export their way out of it, it doesn't work. You can't devalue relative to everyone else, it's not as sustainable. So we are looking at a slightly different crisis here in terms of what's going on. So that's the first point, is this is a different crisis. So we haven't seen we've seen the classic increase in government debt, and there is a sort of balloon theory of debt, where you squeeze it in one area, deleverage in the private sector, the debt pops up somewhere else. And I think we're seeing the balloon theory working quite in practice. In Ireland, it all shifted from the financial sector to the government sector as we basically had the banks being bailed out. Now, what does this mean? Well, first of all, there isn't one point number in terms of your government debt level. First of all, lower interest rates, you can have a higher level of debt. Second point, though, is it's actually a mix of other factors. Demographics is an important factor. If you're like Japan, having a shrinking labor force, this is going to be a much bigger problem than if you're, let's say, like the US, where you have a growing labor force. And then there's a third factor, is actually the way we measure government debt is a bit screwed up. So we don't, for instance, in any of the numbers, net off central bank holdings. You know, if a company talks about the equity, they would net off their treasury stock held by the company. We don't net off the equivalent of treasury stock, which is the debt that's held by the central bank. And particularly as we've had QE programs, 25% of UK government debt is now owned by the Bank of England. Shouldn't we be netting that off and actually saying the debt level isn't quite as high? If you go through the Japanese number, depending on what you net off, you can get the Japanese government debt level down a lot. And we can have a long discussion about what is right to net off and what isn't. But some of this debt can actually be netted off in practice. So the government level of Japanese debt isn't quite as high as all of that. Final thing is, why does this matter? Well, there is a difference between debt and equity. Equity, if your performance goes down, you pay less out in dividends. The problem with debt is it's a fixed payment, however, what happens on the performance. And that's why we need to really worry about this, is that we're entering a world where, for a variety of factors, is going to be more volatile, and we've got more debt, and those debt payments are going to be fixed. So the volatility we're going to face going forward for other factors is going to be worse as a result of the debt level.
That tees off, very interestingly, two sets of solutions. One, in the short term, what do we do to reduce the existing debt level? And two, how do we rethink debt contracts or rethink incentives to make debt safer? Let's just ask the first one, how do we reduce current debt levels, assuming that that is a goal we want to have? Yeah. And you mentioned netting off central banks. That makes me think, well, actually, one way out of this is just to have the central bank buy large amounts of government debt, which it is doing, and hold it to maturity and monetize it. Jason.
I'll leave that to the Fed. Can I talk about my favorite policy that we're working on that's utterly unrelated to your question, or do you want to do that one now? I said before, you don't want debt when it's for stupid things. It's a little bit hard to have a public policy that says don't do stupid things. You can do some of that through regulation, but we do have a public policy right now which tells you to do a lot of financing through debt and not a lot through equity. And that's our corporate tax structure. And if you look at the United States in particular, we have the lowest tax rate on debt-financed investment of any of the major economies, and we have the highest tax rate on equity-financed investment of any of the major economies. And a corollary of those two facts is we have the largest spread between debt and equity. If you look at the tax rate on debt, I think it's minus 35, minus 40, and then you count the individual level, and it's still, integrate that, it's still negative. That's something we really need to do something
about. Have I missed it in the president's priorities?
It is, you obviously didn't read the president's framework for business tax reform issued in February 2012, or my many speeches that I give on business tax reform. So we list that as one of the distortions that we're trying to address in the tax system. And
you would include household debt as well as part of the deduction of mortgages as well?
It's the president's business tax reform
But you would also
plan.
do the same for households, right?
The president does have a proposal to limit all tax benefits to 28 cents on the dollar. So for high-income households, that actually would curb the mortgage interest deduction. In terms of businesses, just lowering the business tax rate and broadening the base reduces that debt equity distortion. But taking a look at the tax deductibility of interest and the tax treatment of debt has to be part of business tax reform as well.
Susan, what would be your top solution?
Well, I would look at household mortgage contracts. So in the United States, as Jason said, households have reduced debt to income quite dramatically, second most in the world, but it's come at considerable personal pain. It's come through mortgage defaults and the complete stopping of new lending. And because we have non-recourse mortgages, it means that creditors can't go after future income or other assets. And the US is actually pretty unique in having non-recourse mortgages. So we've had a large wave of mortgage defaults. People have lost their homes. It's very painful. But from an economist point of view, it is one way to reduce debt to income ratios quite quickly. An alternative is Ireland, which had even higher levels of debt to income, a huge housing bubble. And they're number one in reducing the ratio of household debt to income, but they've done it through widespread mortgage modifications. And so individually they go through borrower circumstances, and they've already restructured something like 14% of mortgages, and there's another 10% in the pipeline. And so it's a different approach, but it has meant that people continue to pay on the mortgage. Banks lose less. You haven't seen the collapse in housing prices and all the externalities that you see in the neighboring houses when somebody defaults and goes into foreclosure and leaves their house. So I would love to see more focus on
the housing finance
loan
contracts.
modifications.
Atif, you have a whole section on that in your book. What would your wish list be for solving this?
So I think first, if the aim is to reduce the level of overall debt, I think we should realize that we really cannot do that. Certainly, we cannot do that without having a large cost. So just try to do the counterfactual experiment of China. What would Chinese economy today look like if it did not borrow as much as it did? And I would say it would be, it will go through a serious recession. So the economies around the world are having higher and higher levels of debt for a reason. They're trying to sustain their GDP, and so therefore they have to borrow for one reason or another. So the question really in my mind is not how we can stop debt levels from going higher and higher. It's really the question is, if and when we realize that someone somewhere borrowed too much and they have difficulty repaying, how can we protect the macroeconomy from the negative consequences of that new realization? And that's going to happen sometime somewhere for reasons that we can't figure out today. The system has to be resilient enough that it can absorb that kind of a new realization. And what that fundamentally means is that we need to move away from this notion that a financial contract has to be fixed in some absolute nominal terms, which is what a debt contract is. And we need to move towards contracts that allow for more flexibility. The Greek proposal, for example, I think it's a perfectly legitimate one. I just wish that's how they had started lending to each other in the first place. We would have, just think of that. The entire Euro crisis, we could have solved that problem if,
This is the GDP-linked bond.
This is the GDP-linked bonds. If we had something like that, the Germans would have had more of an interest to make sure the Greek numbers are more transparent and so on. So you'll have that positive kick to go along with it. But the broader point is really, obviously we talk about it in the book as well. Mortgages, we give a very specific example of flexible contracts where you just share in between the equity. We have the technology to do that. I'm not talking about rocket science really, but we do need to make some structural changes to move in that direction. And I think what Jason was referring to is a very good illustration of that. Without tax reform of the kind Jason is talking about, that huge subsidy that we give to debt over equity, moving in that direction becomes very, very difficult. Let me give you one other change, which is a structural, and so really, it's way above my pay grade, is to change the way we think of bank capital. So now I'm talking about Basel regulation. If you think of the whole risk weight business, banks love that, right? Because this allows them to do a bunch of stuff with very low capital on their balance sheets. But the entire risk weight system is built on this premise. It's incentivizing banks to issue as much of AAA assets as possible. But all of that, of course, is going to be in the form of debt. So we penalize banks, actually, if you really think about it, to issue anything which has more equity-like characteristics from a bank capital perspective. Now, this does not make much sense from a theory of banking perspective as an economist. To me, it makes no sense. But of course, banks will fight for this advantage that they have for a reason. But I think we need to move away from both on the taxation side, the regulation side, and we need to recognize that this lack of flexibility in the debt contract, it really hurts everyone in the long run. There's really a macro externality here. And so without addressing that, I think we'll continue to have these kind of issues.
Thank you. Richard, I'm going to open to questions in a second, but what's your preferred solution?
Well, I think part of it is we have to change the nature of the conversation. We are not having a sophisticated conversation amongst policymakers on some of this stuff. And I think we've got to work out how we do this. So the problem with some of the mortgages, which I love the idea of the bank taking some of the upside, is there is actually a policy there is an expectation mismatch. Almost certainly, the individual thinks their house is going to go up more in the future than the mortgage provider. And that's because we've lived through a period of positive demographics and falling interest rates. So the last 30 years, house price appreciation is not going to be like the next 30 years house price appreciation, because we're not going to have the positive demographics and we're not going to have interest rates falling from 15% down to 2%, which has driven a lot of the house price inflation we've seen for the last 30 years. The trouble is the average person in the street, when they're being told they're going to have to give away some of the upside in this mortgage arrangement, will say, actually, I have higher expectations. I don't want to give away that upside. So we've got to have a much more sophisticated conversation. And I think that part of the way of initiating that conversation is around the changes to the tax system. So the UK gradually got rid of tax deductibility of mortgage interest rate. I think other countries could do that type of thing. The UK went the other way. They removed the tax deductibility of dividend payments. So we actually had an increased bias towards debt as a source of corporate funding, not equity. So I think that there needs to be this conversation about how we change our incentives, how we change our contracts, how we think about government debt differently, how we think about sort of the impact of some of the QE. And I think that one of the ways of doing that is actually start having a conversation about the tax code and the tax codes and that. Because if we don't have this sophistication of conversations, I'm afraid that some of these more sensible products, like the mortgage products, are going to be very hard to get into place because people are going to have different expectations on their house price appreciation. And they're going to say, well, why would I want to give away that upside to a financial institution that has a lower, maybe a correct expectation on appreciation? So how we change that conversation is, I think, the challenge.
Well, this is a place to start. So let's open to questions here or any comments. Yes, gentleman there.
Oh, hi. Just 3 points. On the GDP experience, the GDP-linked bond experience in Argentina, that turned into something of a scam where you had the difference between the inflation-indexed bonds, which were a gain to the government by understating inflation, and the GDP-indexed bonds, which were held by foreigners, who then gained the same nominal GDP rates. So one reason people didn't accept the Greek proposal is because they'd seen what a scam it was before, that GDP numbers are made up by the same governments we're borrowing. And then second point on the demographics, it seems almost incontestable looking at, say, the Japanese, Czech, or even Chinese experience, or that the working age population number, and in fact, actually the gamma, the change in the delta, the inflection point of the working age population is extremely sensitive, and it's at that point that you do get a debt crisis because the decline of the working age population, whether defined as the real population can work or not. That seems to be the most critical inflection point for debt dynamics. And Mr. Herman, on infrastructure productivity, that seems to be assumed by most, not just this administration, but past administrations, that their infrastructure projects are going to be enormously productive, far more so than the private sector alternatives. And yet we get airports in Spain for non-existent planes and Sheriff Palin's bridge to nowhere. There really is a limit to what can we do to measure objectively measure the productivity of the infrastructure you're talking about.
Why don't we start with that, and then we'll talk about how to make GDP-linked bonds
Sure.
work.
The WEO, the IMF's World Economic Outlook, just had a whole analysis of infrastructure. And one of the criticisms I heard people make of that was exactly what you just said. Oh, if everything goes perfectly, it's a great idea, but what if it doesn't? Their analysis was based on empirical averages of past investments in infrastructure. It wasn't some theoretical best case of if you allocated the money perfectly. It was looking at, on average, given how infrastructure has been allocated in the past, what are the rates of return? To have a nominal rate of return in excess of 2% or a real rate of return in excess of 0, shouldn't be the hardest challenge for us to muster as a country. I certainly think we can do better. We have an infrastructure proposal to drive reforms, to have more cost-benefit analysis, an infrastructure bank that would be about depoliticizing projects, taking them out of some of the mindless formulas as well. But even with some of the mindless formulas, some of that politicization, you're still getting pretty high returns in that area.
These are mindless formulas based on historical experience, not mindless formulas based on reasonable projections of future productivity.
The formulas are set in law, And some of them we can change. For example, we're probably spending too little on transit relative to highways. That's an imbalance we'd want to change. We had a program called Tiger Grants, which rather than going through the formulas, had a competitive application process. We had a huge pool of applicants relative to the amount of money we had. We've done a couple of rounds of it. We're proposing another round. TIFIA is a loan guarantee program, and that gives the people you're lending to skin in the game. They have to make sure their product works. They're the ones who get the returns on it. We just put the guarantee. So I think there's a lot of innovative ways we can do that financing that are important and can build on and improve the way we do infrastructure. But even without all of that, it would still, in my judgment, be worthwhile.
Just very briefly, how do you make sure GDP bonds aren't, the government can't mess around with the numbers?
Yeah. So on the feasibility of GDP index bonds, let's go back to 2000, 2001. Just think of the Greek example just to illustrate the point. I would like to be in a world where the only bonds the Greek government can issue are GDP index bonds within the Eurozone. If Eurozone had agreed on that, what would have happened in 2000, 2001? Either the Germans would say to the Greeks, we don't trust your numbers and hence we are not lending to you. Things probably would have been better for Greece and everyone, number one. Number two, if they did not do that, what is the alternative? The alternative is that they pressure the Greeks to improve the accountability and the audit of the GDP numbers. That would have been better for everyone, and they would have been able to borrow. A third possibility could have been that the Germans just would remain foolish and they would lend to them anyways with the bad GDP numbers. Well, that also would have been a good outcome relative to where we are today, because then they would have found out the numbers were wrong. They don't owe as, and then hence the Greeks don't owe as much. Things would be fine, much better than where we are today. So I think if you really think through the economics of it, I think, again, from a macro perspective, that's the key point. This is the right idea. And I just gave you one example of that.
Thank you. Any more questions? Yep, gentleman there.
So going back to China and China's risks, one of the policy statements there has been to try to deleverage by increasing customer debt, which is, obviously a little bit of a brain twister at first, but the math ultimately works out. And that has been a challenge to date. We have a little bit of potentially a similar problem in the United States, and it's hard to find ways to give enough safe loans to people, particularly in bad data and erroneous data areas. Have you guys thought at all about what policies are required to, either in China or the US if it's easier, to help increase the breadth of the debt, in some sense decreasing the depth, if you will?
Susan?
Yeah, we look at China quite closely. China's household debt is very low. It's tripled in the last 7 years, but their debt-to-income ratio is something like 55%, which is, say, half the level of the United States. So to the extent that we see a problem of debt related to real estate in China, it's not a household debt situation, very different than what you saw in the US, UK, Spain, Ireland. It's a property developer problem, and then the ripple effects to the steel and cement industry. So a lot of it is the indirect loans. So what we've seen is China supporting growth. They have been building astonishing quantities of buildings of all manners, residential real estate, office space, convention centers, theme parks, you name it, they're building it. If that market is overheated, and a lot of the loans are being repaid based on the premise that they're going to sell these properties, and because there's no real financing stream. So when real estate prices stop rising, that's a big problem for the people who have borrowed. Now, how to shift into a more consumer-driven economy, we've been talking about this for years in China, and it is the right shift that they need to make, moving away from this gross investment in physical capital towards a more consumption-driven society. And you do see, for banks' parts, mortgages are increasing, auto loans, different types of consumer credit, and financial services products like insurance and savings products are expanding, just not as fast as the economy has been growing.
Thank you. Let's just get on to, I want to get a few more questions in. Stephen.
Thanks. My question is about the relationship between debt and nominal income, and in particular the forecast errors that have come through over the last 4 or 5 years. So obviously debt is a lot higher than people expected, but at the same time many countries' nominal income is a lot lower than people had expected. That growth has been lower in most cases, not so much in the US I admit, but in other cases growth a lot lower. Inflation more recently very much lower than was expected. And of course, we know that the lower nominal growth is for any given level of debt, the bigger the debt indigestibility proves to be. So my question is, to what extent are high levels of debt a cause of these lower growth rates? To what extent will deleveraging make those lower growth rates even lower with the threat of even more deflation? And to what extent might you support the idea that even though debt is too high in the first place, as I think you're implying, even higher increases in debt might be appropriate in the short term to support growth in the long term?
I think, if you look at the two big success stories in some ways in the developed world, in terms of the countries that were hit most by crisis but have done well, have been the UK and the US. They happen to have big quantitative easing programs. We believe the biggest beneficiaries of the quantitative easing programs have not been the corporate sector or the household sector, actually has been the government sector. The government has effectively been able to borrow more cheaply, and if you do start netting off the central bank numbers, actually have reduced their debt. So arguably...
The UK losses cumulatively been very, very big.
Absolutely.
The last year or so.
So is continental European, the cumulative loss too, in terms of the numbers. But so I think that there is a point here about government debt. Expanding the government debt does allow growth to recover. And I think that the austerity we're seeing in some parts of continental Europe is seeing the other side of it. If you have extreme austerity, not prepared to raise debt levels, not prepared to do the classic Keynesian boost, not prepared to do the infrastructure funds that people like Larry Summers are talking about here in terms of that, I think that's a problem too. So I think we should be less worried in the short term about the rising debt levels. We should be saying, look, we've still got, we can't carry on doing this forever. We've got to realize that this is a world crisis. We can't do the Swedish thing of exporting our way out. And let's try and get the economy going. And if that means borrowing more and offsetting some of that through QE programs, and there's big accounting issues about how we actually do that in terms of that, I think we should be prepared to do that and say, let's have a bit of a carry on the Keynesian boost. Because if anything, we are in a demand shortage world. And we've got to find a way of getting demand going again.
I'm not sure that was the headline that came from your report. But that's extremely interesting. Philip. Oh, yeah, sorry.
I just wanted to say one interesting thing. I've never heard anyone say that we have too many IPOs going on, and this is really dangerous for the economy. Why? The question that we are issuing too much debt, that is not the problem. The problem is that it makes it more likely that the economy can go into a downward spiral because of debt in the future. That's the problem we need to address. Yeah. And the solution is you change the nature of that financial contract. It's just as simple as that.
So you have more debt, but you change the nature of the contract.
Yeah.
Philip.
I want to pursue Richard's point about offsetting the debt. So this is where QE's been heading all along, right? So you start off with a half of lager and you end up drinking Thunderbird on the park bench at 5 o'clock in the morning. So,
well, maybe you do.
Here's our honorary chairman. We'll get to the Weimar Republic shortly.
When you start QE, don't worry about it. It's like open market operations, but open market operations, you buy and sell. You only buy. Then you will not have to worry about selling the debt because you were going to not invest when it rolled over. In fact, not 1 cent has been reduced as a pile. When George Osborne took the interest of the Bank of England and allowed it to bring down the deficit. So let's cancel the debt that the central banks own. That would be the way to do it. That would leave a huge hole in central bank balance sheets. And I think the fundamental issue is, does that matter? Or if you think the entire financial system depends on confidence in the money, would it be like going behind the curtain and finding the Wizard of Oz as a little old man with nothing supporting him? Would that be such a risk that even central bankers seem reluctant to do it?
Go ahead.
To my mind, I wouldn't cancel it. Actually, the central bank balance sheets are not like balance sheets, normal ones. They don't have to balance. You could replace them with other assets. You could flip the freeway system in or whatever, another asset to if you really worry about balancing it. So my view, though, is, particularly in a country like here, you can't get into a sensible conversation in Washington about, what is effectively that type of action. So the best thing is just to hold the asset, never let the balance sheet reduce when the debt comes back for renewal by replacement, and just have it there and dividend the interest up, and effectively in present value terms, you've effectively written it off. At the same time, the IMF, who does measures on government debts, need to actually change their measures and start netting it off. So I think that there is a measurement issue by the IMF. They net off stuff held by Social Security Fund, but not by the central bank, which to me seems a bit of an anomaly in terms of the way the IMF does. So I wouldn't actually get into that writing off, because I think there is the wizard issue, and certainly in this country, you couldn't have that sensible conversation.
That's a pretty interesting proposal. There. Gosh, lots of questions now. Angel, we have, can we do one more minute? One last question. I'm being told one last question.
Quickly. Most of the G7 debt yields negative real rates now, and a lot of it is negative nominal yields. So are investors saying that they want more debt rather than less debt? Or are investors saying that what they like is paper that assures you that the principal will be repaid, and so it's not equity-like? Or none of the above, and there is a third answer? Thank you.
That's a very good question. Atif, why don't you answer it?
I mean, that's basically telling us that there are people out there with large amounts of money who just want to keep holding to that wealth. And they're willing to have even negative, as you said, nominal returns to keep holding to that wealth, which is perfectly fine. Again, and I think that's part of the reason we are seeing this rise in debt. Again, the question comes back to the same thing. What happens when that willingness to hold changes? If all of a sudden they demand much higher interest rate, much higher returns on what they are holding, is the economy set up to handle that switch, which might come at some point? And I think that's the real danger of debt. You have to go to flexible contracts. That would be, again, my last slide.